going to let you think about that while we take a break. We're very, very fortunate to have on Public Exposure Dan and Eric Johnson, who are expert financial advisors. You can go to, well, let's go to the next slide, because here's a phone number. If you have questions about your own personal investing, have all sorts of questions about retirement, things of that nature, just give them a call. They're going to answer the questions from a team. By the way, I also wanted to tell you that SCAN, right here where you're watching this, is having its issues with regard to its getting its equitable share of cable franchise fees in the new budget. If you believe that SCAN is something good that the city of Seattle should keep as coming from cable franchise fees, strongly encourage you to just send an email to richard.conlon@seattle.gov. He's the president of the Seattle City Council. richard.conlon@seattle.gov. Okay. Dan, let's go back to that question. The question relates to the market driving interest rates lower for hiring employees.
So I think the primary fundamental issue is that is there a real market? Is there a real supply? Because there's really not that many lenders that are going to voluntarily give money even at an interest rate and while taking risk when they can reinvest it at no risk. That's what the fundamental problem is, that the banks essentially borrow money for free and then turn around, put in treasuries and make money.
So should the Fed increase the rate to 4%?
Well, that's debatable. Going back to your original point, it's probably better to have some kind of stipulation in there that a certain percentage of the money that you're borrowing free from the government needs to be lent out to the private sector. Okay,
so I'm a 40-year-old. We're going to skip over just to let people know in the booth. I'm age 40. I've got 3 kids. Looks like that picture there. What should they be doing for their retirement planning in this market today?
As Eric mentioned earlier, that is the typical household that most financial advisors that are individuals, what we refer to as more of a single perspective planning approach, that's where the commissions are and the transaction fees are people that are accumulating wealth. And that's good for the people that want to do that, but we believe in more a holistic approach that you really need to be in a position where you can be an advisor, be a good advisor for a client for every stage of their life. And really, for a lot of our clients, because of where our history and roots are, they tend to be more in the second and third quadrants of the stages of people's lives.
But if I'm a 40-year-old, I turn on the television, every single advertisement I see is something nasty about somebody who's in government or somebody who wants to be in government. I'm thinking, man, oh man, I'm going to put my money in my mattress.
That's not a great idea, because if you also look at that same news story, you see that sometimes they have burglaries and so forth.
And
not
fires.
real safe. Fires. Not real safe. But you're also not going to get growth that way. And in reality, there's plenty of instruments and products that are safe. There's several that are guaranteed. There's no reason for anyone, no matter how conservative, or if they want to take lots of risk, there's a lot of different strategies that can be successful for anybody on that risk.
And I think that's the key, is regardless of what stage you're at or what your objectives are, we custom tailor solutions for whatever that situation is.
I want to go to basically some competition in the investing world. Are we ready with that first video? Okay, let's go.
Stock trades in the U.S. are no longer being made by human beings, but by robot computers capable of buying and selling thousands of different securities in the time it takes you to blink an eye. These supercomputers, which actually decide which stocks to buy and sell, are operating on highly secret instructions programmed into them by math wizards who may or may not know anything about the value of the companies that are being traded. It's known as high-frequency trading, a phenomenon that swept over much of Wall Street in the past few years and played a supporting role in the mini-market crash last spring that saw the Dow Jones Industrial Average plunge 600 points in 15 minutes. Most people outside of the industry know very little, if anything, about it. But the Securities and Exchange Commission and members of Congress have begun asking some tough questions about its usefulness, potential dangers, and suspicions that some people may be using computers to manipulate the market.
All right, so there we have it, an introduction basically. And that was from 60 Minutes, and from Fair Use. They set forth the issue, and they did a good job of it. 70% now of all stocks traded on the New York Stock Exchange come from high-frequency traders. Is this bad? Is this good?
Neither, really. For high-frequency trading, on the pro side, it provides lots of liquidity for the market. On the negative side, if you're a day trader, if you're trying to market time and trade short-term, that's bad for you because you're not going to be able to beat the flash trading. Their algorithms are, and their computer algorithms are just more sophisticated than yours. Their access to the information is more sophisticated. Not good for them. But for an investor, a long-term investor, it's not really very relevant except at the margins. The high-frequency traders in stocks tend to focus on the large companies, the very largest companies, because they have the most liquidity.
So what you have is, in summary, is an individual going against a computer, a high-powered computer, and so the computer will literally be 2 steps ahead of what the individual day trader or individual market timer sees.
So from a retirement planning standpoint, I probably don't need to worry about them very much.
Now, as one of our clients, it's more based on a long-term strategy and plan that's consistent with your goals and objectives, and so the day trading, the market timing type of scenario would never come into play, no.
So we're going to skip over, and we're going to skip to now about currency markets and why we should even be concerned about it. And there's an article out of the Wall Street Journal, the U.S. Senator Baucus in China. He calls for faster yuan appreciation. And why do I care about that?
Well, you care about it because what happens in China indirectly affects what happens here. If you're an investor, you're probably a more sophisticated one. You're probably investing in that part of the world also. So it's a global economy. It's a global investment world. Everything is interrelated, and this is very important in a couple of different ways. You have a demand. We need to get demand somewhere in our economy.
Okay.
Well, the world economy. A lot of the demands has tended to come from the United States consumer, where the savers tend to be located in other areas, such as China. One of the reasons why a country is a saver or a spender, a lot of it has to do with your currency and how it's valued.
So Dan, in China, the Chinese government is keeping the value down, or at least the value of the yuan down, and they're doing it from a governmental standpoint. Is that a good thing from their standpoint? Is it bad from the United States standpoint?
Actually, what the U.S. is going to advocate is a position that gives the U.S. an advantage over the rest of the world. And
Well, of course.
yeah, and so what it does is that, first of all, you have a situation where most contracts, Chinese contracts, business contracts, are still negotiated in U.S. dollars. So there's not that much of an impact on what the actual exchange rate is, because the absolute
So why do we care
negotiations-
then?
Because it comes down to, is it going to be more expensive or at least less expensive for you to import, export product, and more importantly, your competition in Europe and elsewhere.
I see. Well, I want to go then, speaking of competition, to a New York Times article just from the other day, and this the Chinese oil company, with Chinese oil companies backing, Chesapeake, the largest independent oil producer in the United States, said Sunday it planned to quadruple the rigs operating on the so-called Eagle Ford Shale project from 10 to 40 by the end of 2012, and to bring the shale fields to a peak production of up to 500,000 barrels of oil equivalent per day within 10 years. The whole focus of this is the fact that the Chinese oil company, the Chinese government, is buying up American energy.
Yeah, it really
Should
is.
am I scared of that?
I think you might be at a certain level, because what you have going on is really not, what's in the press is individual companies, but really it's the Chinese government that's implementing a strategy, in my opinion, to start testing the U.S. government into how far it can purchase interest in oil reserves and shale deposits. And why that's important is that unless if the government becomes, or the U.S. population becomes independent of oil as an energy source, then little by little you're going to have a situation where the Chinese will directly benefit from or influence your ability to access that oil.
The show is flying by. We've got to take another break. So we are very, very fortunate to have Dan and Eric Johnson, who are expert advanced financial advisors from Ameriprise right here in the Seattle area. Strongly encourage you to give them a call if you have questions, and we're going to put the phone number up on the screen. While we've got your attention, I just wanted to let everybody know that SCAN, right here where the Seattle Community Access Network needs your help. Right now, you already pay cable franchise fees, and an equitable division of those cable franchise fees is something that if you believe that SCAN is a good thing to have for you in your home, then send an email to richard.conlon@seattle.gov. He's the president of Seattle City Council, and say, keep SCAN.